In this lesson, we'll finish up business combinations by getting into some of the remaining details. Let's get started. First, direct expenses. These are the expenses we incur in the business combination. An example would be finder's fees. That's paid to the matchmaker that brings the parent and the sub together to do the acquisition. Some other examples are consulting fees, legal fees, accountant fees. Gotta pay the accountants. We didn't suffer through this CPA exam for nothing. Here's the rule. Generally, direct expenses in a business combination are expensed as incurred. So the journal entry is just expense increasing, debit. And then the other side is usually cash going down, credit. Easy. There is an exception for costs to register and issue securities. If we're talking about equity securities like stock, those reduce APIC. APIC is an equity account, it's going down. That's a debit. The other side is just cash getting spent, credit. And this rule applies for equity in general, so when you study equity, this is one rule you already know. If we're dealing with debt securities like bonds, then costs to register and issue get recorded and amortized as interest expense. When the bond is issued, we debit debt issue costs, a contra liability. This is the recording part. The other side of the entry is a reduction to cash. This rule also applies to debt securities in general, so when you study bonds, here's a rule you already know. Let's turn to contingent consideration. Here's the rule. Contingent consideration must be valued at fair value as of the acquisition date. Notice, for business combinations, all these fair values are as of the acquisition date. And that makes sense. We're trying to figure out what values to put on these assets and liabilities that parent just bought, and parent bought on the acquisition date. Back to contingent consideration. If the parent might have to pay more for the business combination later in the future, it's a contingent liability. For example, sub's owners told parent that it'll likely make $1 million next year and $2 million the year after. Parent didn't want to overpay up front, so it told sub's owner, fine, if that happens, if you make $1 million next year and $2 million the year after, then I'll pay you an additional $250,000. The acquisition date fair value of this contingent liability is determined to be $190,000. What do we do with this $190,000? It goes to two places. First, we add it to the purchase price, the consideration paid, because it's potentially part of what we're going to pay for the subsidiary. And second, since this is a potential payout in the future, parent records it as a liability on its balance sheet. Going forward after the acquisition, once it's on parent's balance sheet as a liability, this liability gets adjusted to fair value as long as it's outstanding, with the other side of the entry being a gain or loss. Here's an exception. If the contingent consideration is equity, then there are no subsequent fair value adjustments. Now let's get into the subsidiary's pre-acquisition contingencies. Here, we're talking about contingent assets and liabilities that subsidiary already had before it was acquired by parent. We record pre-acquisition contingencies as long as it's probable and can be estimated. If we meet these two criteria, then the parent will recognize the contingency at its acquisition date fair value. Now let's flesh out some of the details. First, we don't have to know about the contingency at the acquisition date. For example, on January 1, parent acquires control over sub. Sub owns an industrial site and is responsible for any contamination. By the way, the site is at the top of a hill. On January 1, no one knows that the site's contaminated. On July 1, 6 months later, the EPA sends a letter that says runoff water at the bottom of the hill is contaminated because of the industrial site. And their tests show that this has been going on for years. Parent looks into it and finds out that it's probably going to have to pay $10 million. First, did this potential liability exist at the acquisition date? Yes, it's been going on for years. Second, is it probable and can be estimated? Yes, parent determined that it will probably have to pay $10 million. Third, did this all get discovered within the measurement period? Yes, it happened within 1 year of the acquisition date. Since it meets all of the criteria for recognition as part of the business combination, it does not matter whether the parent knew it existed or not. The parent has to adjust its acquisition numbers to include the fair value of this contingent liability. Note, for these pre-acquisition contingencies, we need the following disclosures. First, a description of each contingent liability. Second, the fair value recorded as of the acquisition date. And third, the estimated range of possible outcomes. Let's move on to in-process research and development. As a general matter, R&D gets expensed in the period incurred, but there's an exception when in-process R&D is acquired. Then we recognize it as an asset using its acquisition date fair value. In-process R&D is considered to have an indefinite life, so don't amortize, just test it for impairment. Once it's completed and brought to market and converted into an actual asset and therefore no longer in process, then it can be amortized, but not while it's in process. Any subsequent expenditures for that in-process R&D, money spent after the acquisition, will be expensed as incurred, just like the general rule for R&D. Now let's turn to pushdown accounting. What is pushdown accounting? Is it like CPA exam? I hate you! So the subsidiary's assets and liabilities are on its books at carrying value, basically historical cost. That's why each time parent consolidates, we have to mark to market and adjust all of the subsidiary's assets and liabilities to fair value as of the acquisition date. Pushdown accounting gives the subsidiary the option to adjust all its assets and liabilities to fair value permanently on the acquisition date. Then parent doesn't have to keep doing it at every consolidation. The other side of the adjustment entry is usually to goodwill. All right, that was a lot of information. Whew. Let's reinforce these concepts by practicing with some multiple choice questions. These questions come straight from the AICPA, the makers of the CPA exam. Let's read the question first. What amount should be reported as current year expenses not subject to amortization? We're looking for expenses, make a note at the top of your board. Let's read the rest of the prompt. A company incurred the following costs to complete a business combination in the current year. Before we even get to the list of items, let's organize the rules in our heads. First, this is a business combination. That's when one company acquires control over another. In these kinds of acquisitions, the general rule is direct cost gets expensed as incurred. There's an exception for cost to register and issue securities. For equity securities, we reduce APIC. For debt securities, we record and amortize as interest expense. With all that in mind, let's go through the items given. Cost to issue debt securities, $30,000. Does this fall under the general rule, expense as incurred, or the exception? Cost to issue debt securities falls under the exception, and they're debt securities, so it's recorded and amortized. Next, cost to register debt securities. General rule or the exception. Cost to register debt securities, that's going to be the exception. Once again, we record and amortize these costs. Next, legal fees. General rule or the exception. This is a direct acquisition expense. It goes under the general rule, expense as incurred. Lastly, due diligence costs. General rule or the exception. This is a direct acquisition expense. It goes under the general rule, expense as incurred. Let's look at the journal entries. Costs to issue and register debt get treated the same, so we add them together. $30,000 plus $25,000 equals $55,000. That goes to debt issue costs, a contra liability. Liability has a normal balance of credit, so a contra liability will have a normal balance of debit. What's the other side of the entry? We spent this money. It's a reduction to cash. Let's add the direct acquisition expenses. $10,000 plus $1,000 equals $11,000. Acquisition expenses increasing, that's a debit. What's the other side of the entry? We spent this money. Once again, it's a reduction to cash. Back to the question. What amount should be reported as current year expenses, not subject to amortization? Looking at our journal entries, how much do we have in expenses? $11,000, answer B. Let's try another question. What is the total consideration transferred for this business combination? This is about a business combination. That's when one company acquires control over another. So there's going to be an acquisition. They specifically want the total consideration, the purchase price paid. Make a note on the top of your board. Let's read the rest of the prompt. PantCo acquires SuitCo for $3 million in cash, $10 million in stock, and the following contingent consideration. $1 million after year 1, $1 million after year 2, and $500,000 after year 3 if the earnings of SuitCo exceed $10 million in each of the 3 years. The fair value of the contingent-based consideration portion is $2.1 million. What is the total consideration transferred for this business combination? First, Pant pays $3 million cash. Do we include this in the purchase price? Yes, it's part of what Pant paid to acquire Suit. Next, Pant also pays $10 million in stock. Do we include this in the purchase price? Yes, It's also part of what Pant paid to acquire Suit. Theoretically, Pant could have sold its shares on the stock market and paid for Suit with those proceeds. And then we have the contingent consideration. Of all that information on the contingent consideration, what do we care about? Here's that phrase again, the acquisition date fair value. We don't know whether Pant will pay any future amount or not. Future payment is contingent on Suit meeting certain earnings thresholds. Should Pant record this as an asset, liability, or equity? If Suit makes more than $10 million each year, Pant will pay an additional $1 million in year 1, $1 million in year 2, and $500,000 in year 3. This is about Pant paying more cash in the future, so it's a contingent liability. Once again, the rules are contingent consideration gets reported at its acquisition date fair value. First in the purchase price, second on Pant's balance sheet. We know the acquisition date fair value is $2.1 million, and it's a contingent liability. First, let's put it into the purchase price. It's a liability that Pant is taking on, so it gets added to the purchase price. Let's add it up. $3 million plus $10 million plus $2.1 million equals $15.1 million. Answer B. There were a lot of details in this lesson. If you wrote down notes as you went through this video, take a look at the rules and exceptions you wrote and make sure they make sense in your head. If you understand the rules rather than just trying to brute force memorize them, it'll stick better in your mind. Next, I would rewrite the rules a few times as a way to memorize them. Cover up the rules and see if you can recite them. Make some flashcards. Listen to the lesson a few times on your headphones or in the car as you're commuting. The broad strokes of each topic are important, but it's those broad concepts plus the details that'll really put you over the top to passing far. Next up, we're going to review what happens when a parent acquires control over a sub in multiple acquisitions. You want to be sure to hit these points on the exam, so stay with me. I'm Liz Cho with Test Prep in a Snap.